Welcome back. You're watching Stock Watch with me, Zinati Kuma, and joining me to take your stock-related questions tonight are Roy Mutooni from Sanlam Investments and Mark du Toit from Oyster Catcher Investments. Be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS to 41392 or on X using the hashtag Stockwatch. It is the last Stockwatch for 2024. What a ride it's been. I feel like I can still, I still have whiplash from the roller coaster that we've gone through this year. Roy, I want to start off with you. Just looking at, just rounding up the year in markets, what has it actually looked like to you?
It's actually been a good year, strangely enough. I think we started the year talking about geopolitical risk, Israel, 50% of the world's population going to elections, gold, and all that. And then it turns out that the Aussie brings in something like 15, 16%. Even in dollars, it's a respectable 17%. Okay, the S&P was much higher, 27%. But I mean, after all the years of struggling, the local index did pick up. And you had your pick of stocks there. You could get, there were some small caps that did well. There were some large caps that did well. There were some new listings. We Buy Cars was probably the best performing new listing, best performing stock the whole year.
Yeah.
So there was something for everyone. Clearly, the Sasol bulls struggled with the energy price, but that energy price did bring a lot of respite to us. That's why the inflation rate has gone down. That is why interest rates have gone down. And then there's two pots. So it's been a year of a lot, without a doubt.
Yeah. Mark, how would you characterize this? And by the way, there is a question on Sasol, Jen, so we will be going to Sasol for the last time in 2024. But Mark, how would you characterize this year in markets?
And I would say also it's been a good year. Equity returns have been good, bond returns have been good. So I think people who have money invested should be, on the whole, should be happy. And we look forward to next year as well. I mean, we look forward to a higher GDP growth rate in South Africa, higher than we've had for a long time, and continued rate cuts. There will be volatility again with Trump coming in as the US president. There's sure to be ups and downs again of volatility. But I think on the whole, we look forward to another good year. Maybe not as high as this year, the returns, but another good year next year.
All right. Just looking at where the rand is right now, I'm not sure if we will still be getting more gains on there. It's at around 17 rand 86 against the US dollar at this point, as you are recording on the 10th of December. Quite a pleasant surprise, considering that it was sitting at above 18 rand for the longest time. Roy, was this expected?
So this is predominantly global bond yields and the US bond yield. When it stretched up beyond 4.5, 4.6, then the dollar really strengthened post the election specifically. So the dollar went, and on a trade-weighted DXY basis, the dollar was at about 107, and that generally indicates weak EM currencies. So now the dollar is weakened a little bit. I mean, marginally, it's at 106, 105. You can see that the rand's taken a cue from that and has strengthened as well. So you look at it through the year, it's probably been stable. But within that stability, it's gone up 1850, it's come down. It's been volatile within a very tight range. And I think that's not bad. I mean, if you look at it since COVID, it's probably devalued by about 4 or 5% per year. If you look at it in the last 2 or 3 years, it's probably depreciated by about 2.5%. So not the big wild swings that we all have at the back of our minds. A very controlled, tight depreciation, and right now what we're seeing is a stronger currency.
Yeah. I mean, Mark, is this showing fair risk appetite, and maybe that could be supported by the macroeconomic environment that is expected to get better next year?
So I think it is a reflection of that. We've also seen our South African government bond yields come down, another reflection of confidence in the economy. Our inflation rate is much lower than it has been in the past. I mean, we don't have as big a differential in inflation between South Africa and developed markets. So all these things are good for the rand. I mean, we should over time weaken against the dollar just because we have high interest rates, high inflation rates. So that's a natural repricing which should take place. But at this point, we don't see the rand as being overly strong or overly weak. We think this kind of level is fair price for the South African rand against the dollar.
All right. Well, I'm going to the Sasol question now. So actually, this is a funny email. I have a well-diversified portfolio which has generally performed well over the years. However, there are two dogs lurking in there, namely Sasol and AB InBev. Does the panel feel that there's any chance that these mongrels will recover, or should I cut my losses and run? Let's start off with Sasol. I'm trying to look at the share price at this point. Yeah, 93 Rand. Roy, and I guess that's been the question for a lot of people and on different levels. Should I just sell? Because people have just been watching it just getting knocked down. Your take as we close the year?
On the one hand, it is incredibly cheap when you look at it optically on the surface. I think from a PE basis, it's very low single digits. EBITDA, it screens against all the other oil companies really low. But if you dig a little bit deeper, for Sasol to turn around from where it is right now, from a share price perspective, you need to have either higher oil prices or better chemical prices. Oil prices have just been going backwards. There's too much supply of oil, and the likelihood that the oil price continues to decline is actually quite high. Chemicals are quite volatile, not quite recovered. So in reality, there's no macro underpin for that. Sasol also has the ESG problem. Are they going to manage themselves into terminal decline? Are they going to change direction? Are they going to split the US business from the SA business? There's so many questions that you need to answer to be absolutely confident that out of this incredibly cheap price, you could actually race up to fair value, which is actually substantially higher than this. And there's always the question, does the depreciation rate match the level of investment in CapEx? Always a question. But again, it goes back to everything I've said. They've got terminal value risk. There's the macro issues. There's a lot. So it looks cheap, but it will take a lot for it to become a whole lot less. That I think would be my one-handed, two-handed view.
Yeah. Mark, are the risks matching the price? And the question is always, could it go down some more?
So yes, share can always go down more. I mean, it doesn't have a memory of its previous highs. It's all about what the value is today. And I think in Sasol's case, it doesn't have a clear catalyst to really get the share price going. Chemical prices are depressed, and there's still a lot of supply that's still coming online in China. So the outlook for chemical prices is poor. Price probably won't go down, but there's no real reason for them to go up next year. Oil price, as Roy said, it's kind of more likely to go down than up at this point. And Sasol's got, it's got a big capex bill, so the free cash flow doesn't translate into dividends for shareholders. So I think you're gonna probably suffer another year with Sasol until we see. In my view, if we start seeing the chemical prices improve, I think that's really when Sasol has a different story to tell, because then the US chemicals plant will start making dollars. They can pay down their debt. Dividends might come back on the table. So that's what I'm waiting for, and until then, I don't buy Sasol.
What about AB InBev? And I feel like they're quite contrasting views on this one. Well, yeah, specifically this one, maybe more than Sasol. Roy, which side of the fence would you be on here?
So AB InBev is cheap. It actually is. It's probably trading at about a 14 times multiple, give or take, and that's really low for a global consumer stock like that. But exactly like Sasol or any consumer stock right now, you have to look a little bit under the hood. First of all, those South American currencies, the Mexican currency and the Brazilian currency, are very important for them, and those have sold off significantly, which has an impact on earnings. The US is still a little bit shaky. There's been a little bit of a recovery there. But ultimately, I think what will drive a re-rating here is if emerging markets come back into favor, because that's what this stock is about. Emerging markets and then cost of goods being related to food inflation, wheat, barley, and that sort of thing. So this has, I think, a significantly greater chance of finding a catalyst over the medium term to re-rate. It's cheap. The currencies in its base have really sold off. If the dollar does weaken, those currencies recover, and that's probably good. And if in those countries they have lower interest rates, and if global food prices hold up or start coming down, then you've got an underpin to earnings and the potential of a re-rating, because this is quite a low rating for a stock such as this. So I'm a lot more positive. I think you have a little bit of a margin of safety here, and the catalyst will come from one of those three things.
So maybe don't run at this point. Mark, would you be agreeing with that?
Yes, I think there's also a concern around the beer sales, and that there's a view that people are going to start drinking less beer, less fashionable. People start to take more GLPs in the US, want to lose weight. But I think over the long term, I think that this is a consumer staple stock. They do have a bit of a currency mismatch in that they've got a lot of dollar-denominated debt, and they earn a lot of income in emerging market currency. So that is a problem for them. But as they pay down the debt, that problem solves itself. And I think it's just a bit unloved at this point. And I think if you accumulate and you hold it as part of your portfolio, I think that you'll be a happy shareholder in the few years to come.
All right. James, there seems to be some concern on Grindrod. We've had quite a few emails coming through. Should I sell my Grindrod shares in view of the future of Mozambique? And is the stock slowly leaking, and will it sink? Mark, are you as concerned?
I think it is a bit of a worry. I mean, your ports then in Mozambique and all the logistical routes to your port are being impacted by local unrest. I mean, these things do tend to have a way of resolving themselves. So, I mean, it is uncomfortable, but over the long term, that does resolve itself. I wouldn't say that that's necessarily a reason to sell your Grindrod holdings if you've got it. I mean, we haven't owned Grindrod because we don't like the low return shareholder returns, and the stock's also done very well over the last 2 years, so it was looked a bit expensive for us. But I mean, we wouldn't be selling it on the Mozambican news itself.
Yeah, and that's the thing, because I think also it was trading on the fact that it would benefit from Transnet failures, which haven't really moved quite significantly to the upside. Yeah, do you think that, Roy, this could just be a small bump in the road, but holistically the fundamentals are still supportive of Grindrod?
Look, like Mark said, this is a stock that's done incredibly well over the past 2 years. They've provided a new avenue that allowed a lot of the exporters to avoid all the issues around Transnet, and that's in the earnings. They made an acquisition that they still have to make sense for them. That's going to take a little bit of time. I think stocks such as these, you need to take with a much longer term view. So Mozambique is a bit of a problem right now, but like Mark says, these political situations sort themselves out somehow. It satisfies itself. Some new regime comes in or a peace deal, because where Grindrod functions is where these guys collect a lot of taxes, where a lot of exports go through. So it's not indefinite. I think they are good assets. They are very useful for basically the entire Southern African hinterland. But balanced off by the fact that that share price has really rallied. So you can expect a little bit of a retracement when that happens, and then a little bit of uncertainty comes in, people take profits. But that doesn't make it a bad company, that doesn't make it a poor management team. I actually have high regard for the management team, for the restructuring they put in place. And I think over time, it's a solid stock. Returns are low for the capex intensity that they have. But yeah, I don't think Mozambique on its own is a reason to sell.
Well, let's go into another logistics counter, Super Group. It's almost completely eliminated the gains following the disposal announcement last week. What's changed? Is the risk of the deal too high, or is the market completely mispricing it? SG Fleet at the agreed price now outprices current share price, meaning local operations not valued or negative. I mean, this was the jewel of the crown jewel, rather, Mark.
SG Fleet, yeah. So, I mean, basically what happened was a private equity group made an offer for SG Fleet, which is the Australian business. And at the time, I mean, we were wondering, what management would decide to do with the offer. They did put out a sense to say that they were going to use a portion of proceeds to pay down debt, and then they're going to pay a special dividend. And I mean, I guess the question then is once that's happened, you do get your special dividend, but what is left in Supergroup then?
Yeah.
You've got a smaller business. You still have issues with the 4 dealerships in the UK, and perhaps it's just a case of investors not really knowing what they're buying going forward. I mean, when the deal was announced, I thought that they would use proceeds to reinvest into something, but saying that they're going to pay out a special dividend, shows that they don't have something that they're looking at already to acquire with the cash. So I think it's just a case of not exactly knowing where the future of this business lies.
Roy, would you have any concerns about what is left in Supergroup?
No. Well, the thing is, like Mark says, the European business has a bit of an issue that is structural, and I think management have been trying to address that structural issue. In all likelihood, you'll probably see that business being merged out or sold out. The Ford dealerships, that was a mistake made by Ford, and Ford need to fix it. But outside of that, I think sometimes the market offers you opportunity. Like the listener says, at 28, it's like this deal never happened. But if you think about it, at 28, if you deduct the special dividend, if I remember right, it's about 16, give or take, then you're left with, I don't know, 12 rands, give or take. And management also said that the earnings of the clean business after this will be like 2 rands, about 3 rands. So it's not expensive. The ramp is not expensive. It's not a high growth ramp, but at least now management will have the incentive and opportunity, because they've paid down their debt, to look for other businesses to invest in or other things to do, or they can focus on turning around the business. So maybe it is an opportunity. The market moved on from this deal because, first of all, it's going to take a little bit of time. I think it will only happen in March. And secondly, there's many other things to do. But the astute investor looks at opportunities such as this and hangs on, or when the market's a little bit distracted, come in and enjoy the ride. So yeah, no, I wouldn't be concerned. I like the management team. I think they've made the right decision. There's been significant value trapped in this structure. Now there'll only be one entry point. Maybe stick around and see what happens.
Well, on the back end of that, we do have a question. Any thoughts on Metair? Could there be another proposition like Supergroup, where value could be unlocked by selling a foreign holding in a company, which then undervalues the local part of the company? I know that they are selling the Turkish operations. Your thoughts on that and life after the Turkish operations, Mark?
Yeah, I mean, I guess it's another business that expanded offshore and didn't quite work out as the management team expected, and now having to sell their operations in Turkey after having to write down assets and take quite a serious knock on the Turkish lira, which really fell out of bed a couple of years back. The future for Metair, I think it's another company that's going to have to really rebase off this level. It's difficult to see. I mean, perhaps someone comes in and buys the South African harness business, which is quite a nice business, but it's quite small. So, I mean, I guess it's kind of a company that you could one day get an offer for it, but in the short term, you probably sit and the share price doesn't do much in the shorter term.
All right. I want to shift gears to telecoms, because I know, Roy, that you do look at these quite closely. Blue Telecoms, Blue Label Telecoms, rather. Yeah, and especially considering the fact that they seem to want to be more aligned with Cell C, which has been a pain for them in the past, and wanting to increase their stake in the business. What does that look like?
So I think you have to think of Blue Label as two businesses. There's the core original Blue Label business, which is a fantastic platform. They're the biggest distributor of prepaid services, and they keep on adding new things. You can buy bus tickets, concert tickets, you can pay your electricity bill and all of that on that, and they get a nice little cut out of it. Very cash generative, fantastic business. And then there's Cell C. Cell C was a mistake in the beginning, and they've spent the better part of 10 years trying to fix that mistake. The biggest thing was, I think the debt was too much. They had to push out all the shareholders, and now they want to be an MVNO. MVNO means you roam on another person's network, you've got your own spectrum, and now you're hoping to make it into that world. The truth is, there's two really big behemoths who've got lots of capex, who dominate that market. So that's going to be difficult. And I think the difficult thing about Blue Label is what happens to Cell C. Cell C is improving. You can see the business model beginning to work. Your bet there is how much better can it get without detracting from the investment case of the core business. Is it expensive? I think it's closer to fair now. Based on what we can see, but there's a lot of potential, and I think there's still a lot more of this story to be written.
All right. Well, let's go into tech and look at the story of Palantir. The viewer says I bought a Palantir at about $13 US based on a stock watch discussion. Is there still more profit in this one? I mean, now it's what, over $70 mark?
Yeah, so I mean, the rise of Palantir has been quite spectacular to watch. Not a stock that I follow closely, but I mean, we are valuation-based investors, and it does look like the value that, well, the share price that you're paying now is way ahead of their earnings. So it's pricing in a lot of future growth. So as I say, it's not one that we own, and not one that we look at closely.
Roy, is this one that is on your radar?
No, not at all. But I think it's trading on a 192 times PE ratio. That on its own tells you five times price to earnings. Its biggest customer is the US government. This is your perfect meme stock. I have no idea why it's run this much. I mean, there's so much expectations on it. It's almost like NVIDIA or the Mac 7 with a lot less cash flow and with a lot less actual stuff happening. The listener's done incredibly well. I struggle to see where it goes from here. I struggled to see where it would go from his entry price.
Okay.
So
all right. Well, some things that you are not struggling with, and that is your stock picks. Mark, what are you choosing today?
Yes, so I'm going for Standard Bank today. We're bullish the South African economy. We think that we will hit the 2% GDP growth rate. And that's fantastic for banks, because then there's more demand for their lending, and they've been currently growing lending at about 5%, 5 to 6% a year. And if GDP picks up, they can grow lending up to sort of 8-9% a year, and that's a huge benefit, and it flows through to their earnings. Standard Bank's been a little bit unloved since its update a week ago. It's this year's earnings impacted by the stronger South African rand, because they report in rands. The year before, they did 25% earnings growth in rands. So I think the market's being a little bit unkind to Standard Bank in the short term. And I think that you'll get earnings growth sort of mid to high single digits. You get a good dividend yield. And it's got scale. It's one of the larger banks, and it has great footprint in Africa. And I think its prospects continue to be good.
All right. Roy, where are you putting your money?
I'm sticking with Telkom. I think Telkom is massively unfashionable, association with government, corporate action that never quite worked out. But if you look at it right now, I think this is a management team that has simplified the business through the sale of sale of Gyro, the towers business. And what they have is the best, pretty much the best fiber business and the lowest cost mobile business. So they can actually stand up to MTN and to Vodacom, and you see it in their numbers. They're growing service revenue in the teens, compared to Vodacom and MTN, who are growing service revenue in the low single digits. And it seems like they have a sustainable competitive advantage there. The legacy business is almost wound down. Once the cash from the sale of the assets comes in, they'll pay down a lot of their debt, and you should see margins beginning to expand. And remember, the difference between them and the others is they're fully SA focused. The others have problems out in Africa, which will take solutions, which will take energy and time to resolve, and they'll get back to dividend paying within the next 1 year. So I think for the price that you're paying, even after this little trot, there's still value in Telkom.
All right. Well, thank you so much for your time and for your analysis today, gents, and really your contribution to the show for 2024. That is all for tonight's Stock Watch. Thanks to our guests, Roy Mutooni from Sanlam Investments and Mark du Toit from Oyster Catcher Investments. Merry Christmas to all our viewers and Happy New Year. We will see you next year. But for tonight, up next, The Close. Stay tuned.